Good afternoon, everybody. Welcome. Since the previous meeting of the Monetary Policy Committee, there have been further indications of a generalized slowdown in the global economy amid the continuing risk posed by the banking and sovereign debt crises in the Eurozone. This negative outlook has contributed to renewed monetary policy easing in a number of countries, including in emerging market economies, in an environment of declining commodity prices and subdued global inflation. Domestic inflation has continued its downward trend and is expected to remain within the target range over the forecast period. However, despite some moderate employment creation, over the past year, the economic growth outlook appears to be threatened by global developments and deteriorating domestic business and consumer confidence. The year-on-year inflation rate as measured by the Consumer Price Index, or CPI, for all urban areas was 5.5% in June 2012, down from 5.7% in May. The categories of food, housing and utilities, and transport together accounted for 3.5 percentage points of the inflation outcome. Food prices increased by 6%, petrol by 14.2%, and electricity by 17.1% on a year-on-year basis. Core inflation, as measured by the exclusion of food, petrol, and electricity from CPI, increased in line with expectations from 4.4% in May to 4.6% in June. Administered prices, excluding petrol, increased at a year-on-year rate of 5.7% in both May and June. Year-on-year producer price inflation moderated further, measuring 6.6% in both April and May 2012, its lowest rate of increase since April 2011. More than half of this outcome was accounted for by mining and quarrying and electricity price increases. Food price inflation continued its downward trend with agricultural prices increasing at a year-on-year rate of 1.7% in May, while manufactured food prices increased by 8.4%. The inflation forecast of the bank has been revised downwards since the previous meeting of the MPC, apart from the final quarter of 2014, when a slightly higher outcome is forecast. With inflation expected to have peaked at an average of 6.1% in the first quarter of 2012, it is now expected to continue to moderate over the next few quarters, reaching a low of 4.9% in the second quarter of 2013. Inflation is then expected to remain fairly stable around the 5% level to the end of 2014. Inflation is expected to average 5.6% in 2012 and 5.1% in both 2013 and 2014. The improved forecast is mainly due to lower than expected recent inflation outcomes. The forecast for core inflation is also more favorable, although the upward trend is expected to continue in the short term. Core inflation is expected to measure 5.4% in the final quarter of this year, 2012, and the first quarter of 2013, before declining and averaging 4.8% in 2014. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the second quarter of 2012, were almost unchanged since the previous quarter and remain anchored at around the upper end of the target range. On average, respondents expect inflation to average 6.1% in 2012 and 6% and 6.1% in the next 2 years, respectively. The break-even inflation rates declined across all maturities since the previous meeting of the MPC to within the target range. The outlook for the global economy has worsened somewhat since the previous meeting of the MPC, with mounting evidence of a broad-based global slowdown. Negative indicators include a fall in the global manufacturing PMI to its lowest level in 3 years. The lack of meaningful progress towards a resolution of the Eurozone crisis continues to be a source of global instability and risk, despite initiatives to stabilize the banking sector. The growth outlook for the region remains negative, as fiscal austerity measures and the bank deleveraging continue to impact adversely on growth and on unemployment rates that have reached new Eurozone-era highs. In the first quarter of 2012, most of the Eurozone members recorded negative or marginally positive growth, particularly those in the periphery. The UK economy is also currently experiencing a recession. The US economy slowed in the second quarter and the outlook has deteriorated. Concerns relating to the so-called fiscal cliff, the possible sharp contraction of fiscal policy in 2013, are beginning to weigh on consumption and investment decisions, and these pressures are expected to intensify during the second half of this year. Any resolution of this issue seems unlikely before the end of 2012. Spillover effects have also been felt in emerging markets. China recorded a growth rate of 7.6% in the second quarter of 2012, the slowest since early 2009, amid a property market downturn and weak exports. It is still unclear if the policy responses of the Chinese authorities will be sufficient to contain this trend. Materially slower growth has also been recorded in both India and Brazil. In response to these developments, monetary policy has been eased in a number of both advanced and emerging market countries. In the UK, the Bank of England increased the size of its asset purchase programme, and although the Federal Open Market Committee has not resumed its programme of quantitative easing, the maturity extension programme has been extended, and monetary policy is expected to remain highly accommodative for a prolonged period. Global inflation continues to be benign, given the slowing growth prospects and the lower commodity prices. One area of risk to the inflation outlook emanates from the higher grain prices in response to the continuing drought in the United States. The increasingly unfavorable and volatile global backdrop continues to impact on the rand exchange rate, primarily through changing risk perceptions in global financial markets. Since the previous meeting of the MPC, exchange rate volatility has increased and the rand has fluctuated in a range of between 8.06 Rand and 8.70 Rand against the US dollar, partly in response to fluctuations in the euro against the dollar. The rand has, however, appreciated since the previous meeting by around 3.4% against the US dollar, by 5.5% against the euro, and by 3.7% on a trade-weighted basis. During this period, the rand was also impacted by strong inflows into the domestic bond market, following the confirmation that South Africa would be included in the Citibank World Government Bond Index from late September. Since the beginning of the year, non-residents have been net purchasers of South African government bonds to the value of 60.1 billion rand. In June alone, net purchases of bonds by non-residents amounted to 21.7 billion, the second highest monthly inflow ever into the bond market. Much of this is estimated to have been real money inflows, which possibly contributed to the generally appreciating exchange rate trend in that month and declining yields in the domestic government bond market. These inflows are expected to persist for some time after the actual inclusion in the index and will not only help fund the fiscal deficit, but also the widening current account deficit on the balance of payments. The rand is expected to remain vulnerable to erratic shifts in global risk perceptions. While a deterioration of global risk sentiment could cause further rand weakness, this could be offset to some extent by continued inflows into the bond market or the possible resumption of quantitative easing in the United States. The domestic economy appears to be slowing further, following the 2.7% annualized growth rate recorded in the first quarter of 2012. The bank's forecast of GDP growth for 2012 has been revised down from 2.9% to 2.7% and to 3.8% in 2013. The forecast for 2014 remains unchanged at 4.1%. However, given the possibility of a more widespread global downturn, the risks to this forecast are seen to be on the downside, with the external impact coming through trade links and commodity prices. The bank's estimate of the output gap is unchanged at around 3.5%. The composite leading business cycle indicator of the bank declined for the second consecutive month in April, indicative of the uncertain and subdued outlook. The mining sector is expected to achieve positive but modest growth in the second quarter for 2012, following the 16.8% annualized contraction in the first quarter. In May, the three-month growth was 1.3% and 0.8% on a year-on-year basis. Despite this improvement, the mining sector is expected to face a number of challenges, including declining commodity prices and further domestic cost pressures, which have already resulted in stresses for some platinum mines. The manufacturing sector, which grew at an annualized rate of 7.7% in the first quarter of 2012, is showing some signs of moderation in the second quarter. In May, the sector grew at a year-on-year real rate of 4.2%, but contracted by 0.9% on a 3-month to 3-month basis. The Kagiso BER Purchasing Managers Index fell to 48.2 index points in June, its lowest level since August 2011, as the sub-indices for business activity and new sales orders declined further. This is consistent with the weaker RMB BER Business Confidence Index, which declined by 11 index points to 41 in the second quarter. Growth in real gross fixed capital formation lost momentum, having moderated from an annualized 7.2% rate in the final quarter of 2011 to 5.3% in the first quarter of 2012. Of concern is the substantial decline in the growth of private sector fixed capital formation to 1.8%, following successive quarters of steady increases in excess of 5% during 2011. This development, if sustained, will contribute to the fragility of the growth outlook. By contrast, increases of 13.1% and 9.3% were recorded by public corporations and general governments, reflecting capital spending on infrastructure. This was consistent with the improvement in the FNB BER Civil Construction Confidence Index. However, the FNB Building Confidence Index declined further and remains at low levels, with the real value of building plans passed declining by 8.7% on a 3-month to 3-month basis in April. Final consumption expenditure by households, which grew by 5% in 2011, also appears to be slowing somewhat, with growth having moderated to 3.1% in the first quarter of 2012. While real retail sales increased by 6.4% on a year-on-year basis, the momentum appears weaker, with sales declining by 0.8% on a month-on-month basis in May, while in the 3 months to May compared with the previous 3 months, sales increased by 0.4%. The FNB BER Consumer Confidence Index deteriorated in the second quarter, with the index declining from 5 to -3, the lowest level of the index since 2008. According to the RMB BER Business Confidence Index, confidence of retailers declined markedly during the same period to its lowest level in 2 years. Somewhat anomalously, new vehicle sales have remained relatively buoyant. Growth in credit extension to the private sector remains relatively subdued, with 12-month growth in total loans and advances to the private sector increasing by 8% in May. Growth in credit extension to the corporate sector moderated during April and May, while credit extension to households continued to increase, with growth over 12 months of 7.5% in May. This includes the growth in general loans, including personal loans, which has shown a softer trend, but still at elevated levels of 30.4%. Mortgage advances remain subdued, reflecting continued weakness in the housing market, while installment sale credit and leasing finance increased steadily in line with positive vehicle sales. Despite the increase in personal loans, household debt to disposable income declined further to 74.7% in the first quarter of 2012. Personal loans now account for 11% of total household debt, but have not led to excessive consumption expenditure. Formal sector employment creation has remained slow. According to the quarterly employment statistics of Stats South Africa, in the 4 quarters to the first quarter of 2012, just over 100,000 jobs were created, representing an increase of 1.2%. The outlook for wage growth is uncertain. Growth in nominal remuneration per worker declined from 6.8% in the year to the fourth quarter of 2011 to 6.6% in the first quarter of 2012, while unit labor cost increases declined from 5.8% to 5.7%. This trend may have been reversed recently. According to Andrew Levy Employment Publications, the average wage settlement rates amounted to 7.7% in the first half of 2012, and the outcome of the public sector wage settlement will be important in this respect. Administered price increases have remained relatively unchanged, but we still await NERSA's determination of tariff increases to be granted to Eskom for the coming years. Some of the other important cost push factors may have reached a lower turning point recently. Domestic food price inflation is still expected to moderate further in the short term, but the medium-term outlook is clouded by the drought-induced increases in maize, wheat, and soybean prices in the United States. This has already impacted on domestic prices of both maize and wheat and poses some upside risk to the inflation outlook. Brent crude oil prices also rebounded from their recent lows of around $90 per barrel, partly due to geopolitical factors. Currently, oil is trading at around $105 a barrel, well below the levels of almost $130 a barrel that prevailed earlier this year, and prices are expected to be constrained by weak global demand. The domestic petrol price has declined by a total of R1.40 per litre in the last 2 months, although a slight increase may be recorded next month. The MPC is concerned about the increased downside risks posed to the domestic economy from global developments. The problems in the Eurozone are likely to persist for a protracted period, and since the previous meeting, the negative growth outlook has spread beyond Europe, in particular to the United States, China, India, and other emerging market economies. The negative spillover effects to South Africa are likely to intensify. This unfavorable outlook is reinforced further by the fragile domestic private sector investment and consumption trends, which are confirmed by declining business and consumer confidence. The MPC therefore sees the risk to the growth forecast to be on the downside. The MPC also considered the inflation environment to have improved somewhat, notwithstanding possible pressures coming from food and energy prices in the medium term. Upside pressure on inflation could be offset to some extent by lower global commodity prices, while demand pressures are expected to remain muted. Although the exchange rate is likely to remain vulnerable to global risk aversion, the rand has shown some resilience in recent weeks. The MPC expects inflation to remain within the target range over the forecast period and sees the risks to the inflation forecast to be relatively balanced. In the light of these developments, the MPC views the prevailing conditions to be appropriate for further monetary policy accommodation to the economy that will not undermine the inflation outlook. The MPC has therefore decided to reduce the repo rate by 50 basis points to 5% from Friday, 20th July 2012. While it is recognized that such a move on its own will not overcome the challenges facing the economy, it is felt that it can help alleviate some of the pressures faced by some sectors. A sustained increase in the potential output of the economy will require a concerted and coordinated effort from both government and the private sector. The MPC will continue to monitor both domestic and global developments and will act appropriately in line with its mandate. Thank you. I'm happy to take any questions, and obviously my colleagues and fellow MPC members will also respond to questions that you may have. Yes.
Thank you, Governor. Mary Misa from Business Day. Was this decision to cut rates, which is somewhat surprising, I think, to many people, was it easy to reach? Was there opposition to the idea?
I think, as I've said before, Miriam, that there's no easy decision in the MPC, and this one was a particularly robust discussion because this is, I'm not sure that it's a surprise. I think that there's been a huge amount of comment, which we tend to switch off at a certain point so that it does not enter our discussions beyond. Obviously, we look at what markets are saying and what analysts are saying, but in terms of influencing our decision, that is something we shut out at a particular point. Yes, a robust discussion with pros and cons to the decision, but in the end, a unanimous decision that this is the right thing to do, that it's given the conditions that are prevailing and our concerns going forward, that we felt it was important to be proactive, and then a unanimous decision by the MPC to cut the rates by 50 basis points. Yes, sir.
Yeah, Ed Stoddard with Reuters. Governor, I was just wondering from the tone of the statement, I'm just wondering, do you see the risks to growth as being greater than the risks to inflation? Thanks.
I think there's a question that, you often ask us, do we put more weight on the growth issue or on the inflation issue? Our core mandate is the question of price stability. But in taking that decision, we need to take account of the environment that you're working in, and that prevails. So, of course, we look at growth, and we have given you that our concerns are to a question of a deteriorating growth environment, not just domestically but globally. And it's not whether one weighs up more than the other. We're saying at this point in time, we see inflation being possibly affected in the medium term and by cost push factors, not by the demand side. And therefore, a question of saying we think it's appropriate at this point in time. It's not that we give more weight to one than the other. It's that in this particular circumstance, we feel that the issues of growth are important, the issues, as we've outlined in our statement. This is a very, very difficult environment globally, and we want to look at whether there are ways to minimize impact and spillovers to South Africa.
Governor Frans Wild from Bloomberg, does your inflation forecast contain the rate cut that you've just made? And if not, how do you expect your move to affect the inflation forecast?
I'm going to ask colleagues to add in, so I don't know who would like to take that question. Monde?
Well, the inflation forecast that was presented to the MPC did not take into consideration the rate cut, the current rate cut. So it was a no-change stance that was taken into consideration in the models. If that is, I'm answering your question correctly.
Yeah, no, absolutely. And I mean, how do you expect the inflation forecast to change given the rate cut?
Well, we'll see in the next meeting how the inflation forecast is going to change. We'll take this into consideration in the next models.
It's not a single factor that affects your rate forecast, your inflation forecast. It's a whole range of factors, so that we have looked at the different scenarios in that regard and to see how that will impact. Renee?
Good afternoon, Governor. It's Renee Volgraaf from Sunday Times. Governor, you mentioned that such a rate cut on its own will not overcome the challenges in the economy. But I want to know, referring to the fact that consumption expenditure by households seems to be slowing somewhat, do you expect this rate cut to have any effect on the way consumers spend and the rate of growth of consumption expenditure by households?
I think what we're seeing at this point in time is a repairing of balance sheets. So I would think that this rate cut, if you look at the decline in your debt to household disposable income, you're seeing a very significant decline, in my view, from around 82 to about 74, as we've pointed out. And I think what we're seeing from consumers is a conservative approach that is looking at repairing their balance sheets. This should help in terms of the cost of servicing debt. And if that continues, that can, whether they save, whether they look at how to reduce debt more effectively, if this contributes to that ability to service debt, then it is good in the medium to longer term for consumers as well. We're not seeing any rapid expansion of consumption. And I think that consumers are being pretty sensible about, their debt repair and their balance sheet repair. Other questions? Anyone? Frans, back to you.
Governor, maybe more generally, how do you expect the rate cut to affect economic growth and the outlook?
Who would like? Lesetja, can I ask you to respond?
Obviously, growth is driven by so many other factors. As the concluding part of the statement said, that we actually need to see more concerted effort from both government and the private sector in order to be able to drive growth. But in terms of the forecast that we have put in the statement, the forecast in the statement does not take into account this rate cut. And in the next MPC meetings, we will see how this thing filters. These things takes time to be transmitted through the real sector of the economy.
You want to add, Rashad?
Thank you, Governor. Just to add what Lisecha said, I mean, it's important to bear in mind that, we're not in the dark. We don't say, we don't have a sense of what impact the rate cut will have on their outlook. It is true that, when we forecast on an unchanged what the existing repo rate was. But in our assessment, we didn't feel that the rate cut would fundamentally change the inflation outlook.
At the back. Yolanda?
Governor, a question via the webcast from Amina. Her question is, the repo rate has already been at a historical low for some time now. How effective will the latest rate cut be in increasing activity in the economy? Thank you.
Who would like to respond to that? But try again for Amina.
Yeah, I think what was emphasized in the monetary policy statement is that we're very humble about what monetary policy does in the context of a number of other policy measures. However, we do believe that at the margins, and that is why we went for a rate cut, that a rate cut can provide a bit of stimulus and help in some areas, SMMEs who borrow, and a variety of other actors in the economy. So as we say very clearly that a number of measures in the economy need to be done to kind of really get the economy on a different path, but this is a small contribution to that.
Immediate response. We'll go from my left, Ed.
Thank you, Governor. I was just wondering, given the risks on the downside to the economy, we're just wondering, does the MPC still have any concerns about the growth in unsecured lending? Thanks.
I'm just looking to see if I can see Renee. Renee, would you like to respond to that? You might just need a mic.
In short, no, we're not concerned about the growth in unsecured lending coming off the base that it is. Something that we could keep on monitoring, but no concern at this moment in time.
Thanks. Renee, can you give us your name and position?
Let me do that for you. It's Renee van Wyk, who's the Registrar of Banks and head of the Bank Supervision Department. Mariam.
Thank you. Well, real interest rates are now negative. How do you feel about that?
They've been negative for a while. But the question about it, if you look at our forecast on inflation, our forecast is for that to be 5% in 2013 and 14, and therefore it would be at a zero level rather than on a forward-looking basis rather than negative. At the moment, for some time, we've had negative real interest rates for some time. So that was not the purpose in any way of the decision. It's something that, we've been at that kind of bound for some time. I don't know if anyone would like to add on that. Renee?
No, my namesake has already answered my question about the unsecured lending. Thank you.
Okay. Anything else that anyone would like to raise? Any questions? So do we have a hushed silence? Yes, sir. You can't find your button.
Strydom from the Times. Governor, why not a steeper cut like 100 basis points?
I think you answered that yourself.
I can't find my button. That can't be the answer.
No, the question of it being stupid. Look, the reality is one's not looking here for great leaps. The question around it is we consider this very carefully, and we've looked at what is a measured response to the circumstance. The question would be forward-looking. What happens? How do things change? And as you've seen, I think that many banks, including ourselves in the past, have had a steady approach to whether we raise or we reduce, depending on the circumstance. And in our view, 50 basis points is an appropriate measure in the circumstances that we find ourselves and what we are concerned about. We did not entertain 100 basis points. It was not something that was considered with any seriousness. Yes, sir.
Patrick McGrody from Dow Jones and the Wall Street Journal. Governor, could you elaborate on your concerns about the South African economy, whether this is more a response to South Africa succumbing to some of the troubling trends from Europe, India, China, as you indicate, or whether it's in response more to domestic weakness?
Well, it's a little bit of both, because I'm not sure you can separate them out completely. I mean, if we look at it, one of the concerns is about what's happening to commodity prices and the decline in commodity prices. The second question would be looking at growth in Europe. If a significant part of our manufactured goods goes into Europe and the Eurozone as a whole is in a very weak space in terms of growth, UK in recession, a number of the countries of the Eurozone in recession, where therefore very little demand. So of course it affects. But if there's a decline in commodities, as all indications seem to be pointing to, then what happens on the African continent is also affected by that, because what happens with growth in China and its approach to what is required for commodities is going to hit the continent. And that is also a very significant role for South Africa in terms of what we see there. So it's not a question of saying simply, we're concerned about the globe. We're concerned about it, but there are spillover effects. And we want to take an active measure that says, are there ways that we can just, perhaps at the margin, because that is what it is about, make a difference that would assist in some buffer at this point in time that would make our South African conditions slightly easier.
Could I just ask a follow-up question
Sure.
about spillover effect? I think it seems that there's more language about the rand in this statement than there has been in some recent statements. Are you particularly concerned about the volatility in the rand and maybe the impact it would have on manufacturers, given that they're also facing headwinds from Europe, as you said?
Look, we're always concerned about the volatility of the rand. It's something that has, it's a feature of our economy and our currency. The question with it is, as we've indicated, it's hovered in a particular band. One of the reasons for our own higher growth at 3.8 is because we've had in our assumptions a slightly more depreciated currency. But given the band it's trading in at the moment, in our view, it is something that we recognize as a factor in what we do. We do not aim at a level of the exchange rate, and we also do not think that any intervention can influence it. But it's something that obviously we are concerned about as a factor that affects our economy. Other questions, comments, additions? Dan? Anything?
No, I think as far as the issue on the rand is concerned, certainly one shouldn't seek to read from the statement how many sentences we spent talking about the rand vis-a-vis other statements that could be of any significance. I think the issues are clear. We are concerned about volatility as such, but one also has to say that in the wake of what has been happening in global financial markets, as we say in the statement, the rand has been quite resilient, actually. Thanks.
Any other questions? If not, thank you all very much. Thanks for being here. Thanks for the team for being here, and for my colleagues for a very robust discussion all round. And I'm sure that we shall have a further discussion in September. Thank you very much, everybody.
Thank you.